Indiacharts publishes Nifty daily video updates, the weekly Elliott Wave outlook, and the long short report covering all asset classes.
When you consider the 2 to 3 week time horizon, we are not talking about day-to-day moves, whether the Dow was overnight up or down last night. But 2 to 3 weeks, what we are seeing over and over again based on this post I did quite some time back is a sort of inversion in the trends between the US indices and the Indian indices, which means that when one of them is actually going up, the other is going down. Though broadly you can see both of these markets have been rising. Now let's take a closer look. This is a zoomed in look. Broadly, both markets rising since the bottom of March 2020. But when we actually take a close look at what's been happening, you see an inversion. What you see is when the Dow is going up right here throughout this time period, the Nifty is sort of down to flat. And then it starts picking up just as the Dow is topping out here and goes into a short-term correction. And that's when we outperform. This pattern's repeating over and over again. You can see it again here. Flattish period, a pickup. Then this goes further down, we go further up. And then this goes down again. This behavior has repeated for quite a while now. You can even go a little back. You can find this is going steeply up when this is sort of pretty much flat. Prior to this, probably we didn't see that much inversion. Okay, so you can see these markets sort of correlated on the way up and down together in the initial phase of the recovery. So mostly we are seeing this, I think, happen after October of 2020. And partly it may have to do with, since Jan 2020, we have seen a stronger dollar, which probably has to do not with deflation, but has to do with the US economy doing better than the rest of the world. So that may have sort of caused this EMDM inversion. That's one way of looking at it if there's no other. That as and when US equities attract more money, it ends up moving away from emerging markets, and India has been one of the better performing emerging markets. So even the most recent corrective phase into September, you see US equities fall. Initially, it looks like they're probably going together at some point, but actually they invert here, and this continues to go higher. So actually the peak in US market is somewhere here. So this has actually been picking up from this point. This rolls over, goes down, we continue to go higher, and just when this is about to pick up and break out of this bottoming range, we sort of top out. So for a while it may look like, okay, they are going up and we are going up together, and then we've actually rolled over and they are still rising into the latter part of November. Now you have a November rollover, okay, and they're starting to top out. We are still here, and the peak panic point is this Omicron, right? So this is exactly where we've bottomed 4 days ago. And they sort of into more panic selling, then up, then a bigger sell-off here. We are still going up, and so this inversion has started to happen. Now, unless we actually see the two start correlating again, we probably presume for the time being that the inversion is still in place, which means that US markets, whether they've bottomed here, which it may look like with this big 600 point up move, or even if it sells off for one more day, we might still be trending on the way up, so that inversion might have already happened and we may not realize it, and therefore we may not really react to day-to-day moves that are actually happening in the US market, because directionally we are now in the opposite direction. So this kind of intermarket divergence can be interesting, and none of these correlations really remain permanent. They change over time, and then you have to really think about what happened during that time period that caused the change to take place. And that's exactly what I discussed in a very, very recent post, because given what we are facing right now, tapering from the US, you're trying to really understand whether there was a relationship between the dollar and the bond market. And I've really not seen it historically, but thinking a bit and plotting it together sort of gives you a sense of how this may have really played out over a period of time. So I'm going to look at this as a monthly chart, the blue line being the dollar index, and the purple line here being the 10-year treasury yield. Okay, so we are looking at interest rates, yield, not the bond price. And what you then see is that there was a spike in interest rates that started back here. This is of course the 1980s. So late 1970s, 80s, the high inflation rate and rising commodity prices. We saw push up in interest rates. And as interest rates were raised, initially the dollar remained flat. So it was in a previous bear market. And so there's a lead lag between the dollar and interest rates. The rising rates actually caused the dollar to start rising in the latter period. Okay, and then here rates peaked out, started to fall, and the dollar then eventually followed. So this is sort of the lead lag behavior we've seen throughout history, and that we've come to know as staying out there. Now, once again, you had a phase where the dollar did rise, but you haven't really seen much of a rate increase. So there's some sort of an inversion happening in this phase, and this is actually 1996 to the year 2000. Now, this may also be associated with a period where you had the tech bubble, and so a lot of money went to the US because of Y2K, and rates in terms of the bond yield was still falling. They very temporary move up here, but it's nothing that we can say was a major trend. But these falling rates eventually have again taken the dollar further down, right? So post the tech bubble bust, which would have happened in the year 2000, which is this point, rates were further cut. So you had this small rise in rates, okay, along with the rising dollar, but that didn't last. Rates started to be cut again into the tech bust, and the dollar continued to fall through that time period till we hit 2008. Now, for a while, it looks like this relationship is still in place because the dollar remained under pressure till 2011-12, and yields are still falling. And then you had the dollar rise again. And this time around, you don't have yields really going up. Though in the near term, what I noted in my post is there's actually an inversion. So this is in a period where we started QE1, QE2, and I'm going to actually move to a daily chart so that we can see the inversion more clearly. And what therefore I noted is when you see the previous time horizon, where if yields fell, the dollar fell, sort of that happened into this time with some kind of lead lag. So it may not appear, it may look like yields are rising and the dollar is falling over here. But eventually, if yields were falling, it caused that to happen. But in this time period, we're actually seeing a very clear inversion slowly build up. I think probably from back here where stimulus has started, 2009, 10, you can see rates and the dollar actually starting to slowly move in the opposite direction rather than in the same direction as they were doing back here. So both were falling here, but now you have a situation where this goes up, this goes down, this goes down, this goes up, down, up, and so on. Even in these larger swings, you can actually see this going down when this is going up, this going up when this is going down. So why do we have this inverse relationship? And the dollar actually peaked. So the dollar bear market started, to me it started here, and then we had a double top here. So this is 2017, and that's when yields were actually rising because of the strong stock market. And then, of course, they sold off post 2019 as market volatility picked up and there was a risk of trade. Now, during that risk of trade, you had the dollar actually going up. And for a long time, it looked like falling yields should have taken the dollar down. And since this is the peak, it should have ended at a retracement. But it's only in the last leg, when the pandemic hit, you had yields fall still further. And you had a last dollar spike, which caused the double top. And then the dollar's been falling. And this entire period where the dollar's falling, stocks are doing well, yields are actually rising. So yields are rising along with a rising stock market. That's been the theory so far. And here the dollar started to bounce back. So this is Jan of 2021. Since then it tried one bounce, sold off, did a double bottom again, tried another bounce. And while it's been doing all of that, bond yields also peaked a little later, sometime in March, I think, of 2021. Came off, then made a second attempt to go to a higher high, but couldn't really make it. And this is despite all the news flow around inflation and the Fed tapering, and they'll probably raise rates in 22 or maybe 23 or late 22, they'll start raising rates. All that news flow, but bond yields are actually not able to make a higher high back here. And so the moment they start tapering, yields are actually falling. Now that's been sort of the experience we've seen throughout this period. As and when they back off on the quantitative easing, the buying of bonds, bond yields actually start to decline in a risk-off trade. Whereas when they're actually doing the bond purchases, equities do well as asset prices go up and bond prices actually fall, pushing up yield. So this is sort of causing the inversion. That's the reasoning I've put behind it. That earlier you had a more direct relationship because it was Keynesian economics 101. You cut rates, the dollar falls, stimulates the economy. But now what you're getting is a very different scenario. where you're not cutting rates, you're actually doing QE, and that's having a very differential effect on the market. So that's what I discussed in the recent podcast. I'm only showing it visually here. And the question then is, what is going to follow next? Are yields going to continue to fall and drive up the dollar? Completely the opposite of what you'd fundamentally think is supposed to happen. Rising yield should push up the dollar. But that's not what we are seeing since the last 7, 8 years or 10 years in this relationship. And if that is true, and yields actually start rising, because of tapering or raising of rates, then is the dollar actually going to fall in that environment? But it's not going to be the tapering or raising of rates, at least not raising of rates. It's going to be the bond market itself. It's going to be a reflection or response to equity. So basically, if equities are going to do well, and that means bond prices are going to fall and yields are going to rise, you might actually end up with a falling dollar. So that's what I'm trying to highlight. Though you can also argue that while this dollar rise has been happening, US equities have anyway done well, but yields are not rising anymore. So this is a tricky spot to have, and so which is why the only relationship I can draw here is this inversion. That if yields are not rising, the dollar is going up, but when yields actually start rising, when you actually see that, then maybe the dollar starts falling. And that's the relationship we have been seeing for the last 10 years. So you're going to follow what the yields are doing. For the time being, it looks like yields are off a bit, but it's not clear whether they remain in a range or they're going to go further down or they're actually going to go further up. Most people would think, given the announcements around an increased pace of tapering, yields should actually start rising. If that is true, then the dollar should actually fall and not rise based on the relationship that it has been doing over here. So that's the interesting fact. We're going to see whether that plays out exactly as I'm saying, or something actually changes in this relationship again. So last but not the least, we have to end up looking at what the Nifty has been doing. And it's been a pretty big extended rally. And the question I've gotten over and over again, especially this time around more than the previous time, is has something really changed in the nature of the market based on how the correction has taken place? Now, it looks like a much deeper correction, but in terms of retracement, it's pretty much close to what, or rather in terms of size, percentage decline, it's close to what we've seen before. Retracement, probably not, because this was a 50% retracement back here. But this decline here is almost 10% decline in the index. But this was the first correction from the pandemic highs. So once we got that bounce back, the first pullback was around 10%. And since then, most corrections have been smaller. And this one at around 8 to 9% is probably the largest since. So that's the highlight of this period. Another thing that we see is we haven't really seen trend lines hold. So we've been redrawing these trend channels. Okay. And because they've not held, we can't really draw one here and say it's broken down, because this has been the pattern. As the market's gone higher, it's moved at a probably slower and slower pace, but that hasn't really stopped it from moving up. So how are we going to really know whether it's reached an endpoint? Something in the nature has to change, either in terms of the structure of a correction or, breaking of certain levels. We'll be watching into this weekend whether we are able to hold weekly moving averages, because we sort of broke below that. But in terms of structure, which is what I'm focusing on here, we've sort of seen a 4, 5, 6 week correction each time. You've sort of seen an ABC pullback. So when this correction actually started, when I go back 2 months, what I was predicting, and I think I said it even on CNBC, is that this could be a consolidation and a triangular pattern, simply because we'd completed 5 waves from the bottom in July. Late July we bottomed, and then we moved up on the weekly chart in what looks like 5 waves. So I've marked it here. Now, once you complete 5 waves, wherever we've done that in the past, whether it's at this top, or whether it's at this top, or whether it's at this peak where the Nifty 500 peaked, we've actually seen an ABC pullback, where if I take this as A, B, and C in terms of time, C is 1 week, A is 1 week, and you have a 2 week in between bounce. Similarly, if I take this as an ABC on the weekly chart, this 2 weeks down, 1 week bounce, and 3 weeks down. Sort of this took 4 weeks to complete, this took 5 weeks to complete, and the recent correction has been 6 weeks. And within that 6 weeks, you have 2 weeks down. So if I broadly mark this as an ABC without looking at the internal structure, okay, the C wave is 2 weeks, the A wave is 2 weeks, and in between you have a 2 week bounce. So sort of the same kind of structure, The only difference, it didn't end up being a triangle. I thought it would be a triangle from the bottom that we made in early November, right after Diwali. But we ended up breaking that low, and the structure has changed from what would have been a normal triangle to more like a zigzag correction. And whenever we've had a zigzag correction, so now I'm moving to the daily chart. Whenever we've had that, the nice debate to have has really been whether it's a third wave or a fourth wave or what. So if we actually started marking this as 1 and 2, and we say this is 3 and 4, actually the structure of 2 and 4 are pretty much the same. Retracements may be a little different, but they're both downward channels, ABC type of declines. And so you have alternation missing. Now alternation is not a rule, it's a guideline, but the guideline can sometimes avert you to the possibility that you have an extended wave. And that's the discussion we had, I think, even on Twitter, whether this can actually eventually turn out to be 1, 2, 1, 2. And we didn't have the answer till the final answer only came once we actually broke out of the April to May consolidation phase. So this looked like a triangular phase. That was the first giveaway. The moment we saw this was triangular, it was the first giveaway that this has to be 1, 2, 1, 2, 3, 4, because triangles typically occur in fourth wave. So we finally got a fourth wave correction. And once we got a fourth wave correction, then this fourth wave cannot be the end of a 5-wave advance, 1, 2, 3, 4, 5. And so we broke out of this and started a fresh move. So now we are looking at 1, 2, 1, 2, 3, 4. And the question is, where is 3, 4 and 5? So I would have liked a triangle. Like I said, I would have liked a triangle over here. I would have then marked this as a fourth wave. But instead, we have completely something else. Now, should we take this consolidation phase as a fourth wave has been a question. It's been so flat. Nothing compared to the previous corrections, that it will remain a question of the future. But what I am more intending towards looking at this double zigzag correction out here is that double zigzags or zigzags are more typical in second waves, and this has done an exact or almost 61% retracement of the last leg. Now, of course, 61% is the deepest yet. So far, we only saw close to 38 to 50% in between that in the last second wave. In May of 2020, which is all the way back here, which we just saw back here. And when we come back to the current phase, this is the deepest yet in that sense. Otherwise, percentage wise, it's still smaller than that first correction. So having reached 61%, the question I'm trying to raise is this really a second wave of some degree? Is this a 1 and 2 of some degree? Now that is completely crazy because it's outrageously bullish. And as this rally has gone on and on, people would like to call the end, most probably say that some kind of 3, 4, 5. This is 3, 4, 5. We can actually say this is over, and every bounce is a sell-on bounce now from here on for the market. But somehow when I look at individual sectors and I look at individual stocks, I do not see that kind of decline. Many of them are just consolidating. And it leaves that open-ended question, because we've actually seen markets extend themselves longer in the 2018, 19, 20 period. Even here, when the mid caps actually peaked and stocks were falling since 2018 back here, we saw this long topping process where markets zigzagged in a broad range with larger swings on the way up and down. So why can't we see something like that? In fact, for all you can even argue, why won't you end up with an ending diagonal over here? Something like this. But an ending diagonal is a 3-3-3-3 structure. It's not a impulsive structure. It's not a 5-3-5-3-5 structure. And therefore, if we've actually seen a 5-wave advance here, why should we really be ending up in a 3-3-3 structure unless it's a running triangle of sorts? So we'll see how this unfolds. It's still early days, but if it's 1 and 2 and I end up projecting a third wave, then we actually end up saying it's going to go way, way higher. But if we actually move on to the mid-cap index, there we do see some sense of a 3-3-3 possible structure. This last rally from the bottom in August to the high that we saw in October actually looks like a 3 waves up and a 3 waves down. So this is where the ending diagonal doubt actually came in my mind. It's too early to conclude, but I actually started to think if this rally we are not able to very clearly fit a 5 into, are we really doing some kind of triangle which could be an ending pattern, 3-3-3-3-3. For all the mid-cap index does something very, very different from the Nifty. Or all the Nifty actually starts to outperform the mid-caps for a period of time. And this ends up forming, if not an ending pattern, then a running triangle. Let's see. So there's a sense of a triangulation possibility coming from the mid-cap index, but not so clearly from the Nifty, and that's going to be another thing we're going to keep discussing and watch out for as these waves unfold. Now, to everybody watching and listening to this, this might be the most optimistic outlook yet, because what everybody wants to hear is this: 5 is over, is over, is over. At least that's the sense I'm getting when I listen to everyone, when I listen to people's comments, and I feel that they just want you to say this. Why don't you say this? Why don't you conclude it's done? And my kickback is everything I've just discussed. These observations in terms of the corrective behavior, retracements, and so on, something has to change in the nature of markets. And if it has, then probably I'm not able to see it. But my sense is it hasn't. It's still the same as every other correction that's happened in the last 6 to 8 months. Maybe we've seen some weakening or slowing down. Like we said, these trend lines keep breaking. So the pace keeps slowing down. But we may or may not have reached the conclusive end. We may be in late stages, but not a conclusive end is what my mind is really telling me. And then we need to ask, what actions are we really taking? If you thought this was a peaking point, somewhere by the 1 week down, we could see the 5 waves on the weekly time frame. Once that was done, people would have had different levels of expectation on how far lower it can go. Mine were probably the least, but if you really had an expectation that it's coming back here, and I'm sure some people did, some people thought it's coming back here. The question is, what did you really do in this time frame? Because most sectors or indices have retraced 50 to 60% as I'm looking, and if they have done that and the larger trend is still intact, then you are right, and it was an opportunity. The problem is I'm seeing with some, at least, of those very same people give up and start projecting that this is going to be the likely scenario. It was all a bubble. We should have seen it coming, and Omicron will put an end to the world. Or if not that, probably tapering will. And that's where I find the thought process missing. Same people who would have probably bought 1,000 points lower are now running for the hills, which is the psychology that doesn't really fit here, because if this was truly a bear market, people would be buying the dip, lock, stock and barrel, and getting stuck. Instead, the behavior that we've seen over the last 4 to 5 days down here has been that of a selling climax, where people has completely given up. It ran right into expiration. So that was another very interesting feature of this 2-month correction, is that initially this whole fall starts 2 weeks before expiration and ends 1 day after expiry. This bottom is exactly 1 day after expiration. Same thing starts here. It starts peak 2 weeks before expiry, and then this low point is 1 day after expiration. Very interesting that it followed the same pattern in both these legs of the correction. The first ABC and the second ABC correction, both of these declines lasted for 2 weeks and occurred around the same time in the month, which was sort of a seasonal repetition. And one of the reasons I think that may have happened is, whatever losses people make during that time period get paid off by selling stocks in the cash market, post expiry to, for all the margin sales that end up happening. So the margin losses are paid by, selling from the book, and that shows up 1 day after expiration or 2 days after expiration typically. And that's the selling that you've seen down here, and that's the selling climax I'm talking about. So what we have to really judge is that this bounce back doesn't end up being a fake like the last one we saw here, because this one also occurred post expiry, but it ended up being a head fake. And it was a head fake because we couldn't really get past the 61% retracement mark. So what we'll end up watching then again is the 61% retracement mark, at least of this last leg to start with. And getting past that is going to be the main hurdle first, and that's around 17,664. We have, of course, broken past the initial downtrend channel, which is this one yesterday. And what we'll be watching is whether we can get past 17,664, which would be the second sign that we've sort of bottomed out and started to break out on the upside. That's all for me for today. Thank you.